World War I. It remains in our memory with muddy trenches, the roar of artillery, and bloody military failures. But the real, secret battlefield of this massive conflict was in the banking halls of Europe. In fact, the fate of empires was decided not so much by the shots fired in Sarajevo or the initial rush to mobilize, but by an unprecedented, secret financial collapse that occurred weeks before the armies fully clashed. This war was essentially a global financial uprising, where physical bullets were replaced by fiscal tools like debt, inflation, and financial cunning. The instability that defined the 20th century began in the silence of the markets. Between the declaration of war on July 28, 1914, and the end of the first week of August, the world experienced a shattering financial seismic shock. A massive sell-off of approximately $3 billion worth of foreign portfolio investments, primarily driven by the British government's need for funds for its war effort, caused a global freeze. The New York Stock Exchange was forced to close for 4 months, and the London Stock Exchange, the anchor of global finance, was shut for 5 months. The scale of this reaction, the complete shutdown of the global financial system, indicates that financiers immediately understood the magnitude of the catastrophe. The main mystery of the economic history of the Great War is this: how could a stable, deeply interconnected global economy, anchored for decades to the gold standard, collapse so completely and so quickly? The global financial system of 1914 was based on the gold standard, a hybrid state-private system covering 59 sovereign nations. Currencies could be exchanged for gold at fixed rates, which provided a strong anchor for monetary value. However, the seemingly stable system was built on a fragile foundation of political cooperation and trust. The ensuing conflict revealed the true power structure. The nation that could manipulate credit, expand a money supply, and maintain the illusion of solvency for the longest duration would win the war. The first decisive blow of the financial war was the immediate and universal abandonment of the gold standard by all major belligerents. The gold standard, which restricted the volume of money based on the central bank's metal reserves, instantly became irrelevant. The political imperative to finance the war immediately superseded the economic imperative to maintain currency stability. With the suspension of convertibility, governments gained the ability to increase the money supply without limit, a decision that directly led to sharply accelerating inflation and encouraged speculative economic behavior across the continent. Even neutral Sweden experienced excessively high inflation. This demonstrated that inflation was a generalized effect of the shift in global monetary policy, a hidden tax imposed on citizens everywhere due to political interests prioritizing monetary expansion. The scale of the war demanded the mobilization of financial resources on an unprecedented scale within a deeply interconnected and highly developed world economy. For almost all participating countries, the traditional direct method of financing, taxation, was politically unpalatable and consequently played a subordinate role, paying for at most 1/4 the actual war costs. The majority of the war was financed through borrowing. In Great Britain, government debt rose catastrophically, from about 25% of gross domestic product (GDP) to 125% over 4 years. This exponential debt growth was a fiscal mirror of the static, grinding conflict in the trenches. Despite their strategy to finance the Allies, Great Britain faced a deep crisis early on. The 1914 war loan failed, raising less than 1/3 of the target £350 million. The Bank of England orchestrated an emergency secret cover-up. To bridge the shortfall, the bank secretly advanced funds to its own employees, who then purchased the securities in their own names with the bank's money. John Maynard Keynes described this manipulation as a masterly piece of manipulation. This incident revealed the institutionalization of central bank secrecy and the necessary cunning required to maintain confidence. The Central Powers adopted a different, equally risky strategy. Germany's grand strategy was based on issuing war credit. This was a Siegfried's gamble. They hoped the emergency budget would be entirely paid off by a massive indemnity, a Siegfriedian piece of victory, to be extracted from their defeated rivals. This created a domestic financial time bomb if the military gamble failed. While the European powers were crippling themselves, the U.S. remained officially neutral. Nevertheless, J.P. Morgan and Company became the principal purchasing agent for the Allies, managing the acquisition of $3 billion worth of war materials. Morgan established a shadow financial state, facilitating purchases through financial vehicles like the American Foreign Securities Company, AFSC. The firm's activities ensured that the global financial center of gravity shifted to New York even before the U.S. officially entered the conflict. By 1916, Great Britain had run out of money to finance its allies. In 1917, the U.S. government officially took over the role of extending credit to the Allies, insisting on repayment after the war. This moment marked the final, decisive turning point in global financial hegemony. The U.S. transformed from an industrial supplier subsidized by private bankers into the key sovereign creditor, sustaining the Allied war effort. The financial war was waged not just on balance sheets, but also on the seas. The British naval blockade of Germany was a strategic effort of economic coercion, soon dubbed by officials as the Fourth Fighting Service. The financial impact of the blockade on Germany was swift and devastating. The sharp decline in exports and financial isolation became a key strategic weapon, depriving Germany of the industrial products required to maintain its war machine. Victory brought a financial reckoning. The Treaty of Versailles codified the financial debt, with Article 231 holding Germany responsible for damages. The sheer weight of the reparations demands severely destabilized the Weimar Republic's economic stability. In 1923, Germany began defaulting on payments, and hyperinflation ensued. Analysis shows that the hyperinflation was driven less by the reparations and more by the Weimar government's choices regarding domestic policy. When the Ruhr was occupied in 1923, the government chose to subsidize the cost of passive resistance through the excessive use of the printing press. Printing money became the path of least political resistance to finance the domestic political conflict, ultimately leading to catastrophic hyperinflation. The post-war financial system was precariously interdependent on a web of economic dependency, linking the U.S., the Allied nations, and defeated Germany. The Dawes Plan, 1924, stabilized the system by restructuring Germany's payment schedule and providing U.S. loans. This created a circular flow of finance driven by American capital. U.S. private banks loaned money to Germany. Germany used this money to pay reparations to the Allies, and the Allies, in turn, used these reparations to repay their war debts to the U.S. government. This stability was exposed when the U.S. stock market crashed in 1929. The sudden and aggressive withdrawal of American banks from European investments cut the lifeblood of the debt triangle. Germany immediately collapsed and could not pay reparations, which caused the Allied nations to default on their own debts to U.S. This fragile financial architecture ensured that a domestic U.S. financial shock instantly became a devastating international economic event, directly contributing to the Great Depression. WWI's financial warfare set a dangerous new norm for state finance. Relying on borrowing and monetary expansion became standard, a trend that echoes deeply today. For example, the U.S. debt-to-GDP ratio has recently surged to levels equivalent to the peak World War I belligerence. These fiscal figures reflect the same fundamental political choice made in 1914, financing massive government expenditures through debt and monetary expansion instead of politically painful taxation. Britain's conversion of its naval blockade into the Fourth Fighting Service did not disappear. It evolved. Modern weapons are exclusion from the SWIFT international payment system, and, most decisively, the freezing of central bank foreign currency reserves. The 2022 freezing of over half of Russia's central bank assets is a direct conceptual successor to the 1914 crisis response, obstructing a military opponent's access to the foreign currencies necessary to sustain international trade and industrial operations. World War I taught that control over the ability to access hard currency is the ultimate strategic lever. World War I proved that military might is inextricably linked to, and often subordinate to, financial capacity. The real battle was a shadow war fought in the banking halls of London, New York, and Berlin, which determined which nation could sustain confidence and secure funding longer than its rivals. History shows that politicians prefer to finance massive crises with the invisible tax of debt and inflation, a choice that created economic instability, such as the Great Depression, that was more enduring and politically catastrophic than the military losses themselves. Access to credit and economic coercion was a decisive factor in the conflict. Systems built on global trust, whether the gold standard before 1914 or the post-war debt triangle, collapsed instantly under systemic stress. The World War I debt crisis exploded a decade later, ensuring that an American financial shock became a worldwide depression. Today, the U.S. and other major economies operate at debt-to-GDP levels mirroring the peak World War I belligerence. Stability that rests on massive, politically sensitive credit flows is merely a postponed crisis. The key question is not when the music will stop, but where the next global capital withdrawal, the 1929 crash of our time, will occur, triggering the long-postponed financial catastrophe of our current high-debt era. To understand modern debates about sanctions, debt limits, and inflation, one must first understand the century-old financial battles that paved the way. The strategies, successes, and failures of World War I war finance are not ancient history. They are the governing principles of the 21st century global economy.